that's the great thing about multifamily. Even if you have to lower rents for whatever reason, even if you have to do concessions for people, you can get hyper creative on, with tenants and keeping the property afloat. But ultimately, you want to keep that property right there, right? The goal is to never lose a single cent on these properties. And fortunately, because the higher the units, especially, people just need a place to live. You just got to get creative, and you got to weather the storm if the storm ever hits. And that's the best part about multifamily. It's not a single family. You lose a tenant in a single family, you lost a tenant. Like, now what do? You're paying for everything.
Welcome to Money Club Mondays. It's March 28th, 2022. We took the last couple of weeks off out traveling out in Utah, San Diego. So back at it today. Excited to be here. A lot going on with Private Money Club. I believe we secured the 25 investors that we needed for the investment called 25-25-25 Private Money Club Private Founders Investment. So I believe that's filled, and people sending over money this week on that. So Private Money Club's growing. We just contracted the developers to rebuild it from the bottom up, learning from what we learned over the last year with what you see on Private Money Club today. So this Money Club Mondays is a public webinar, but I want to make very clear what we're talking about today with Chris Biz. It makes me call him Biz now.
Biz.
With Mr. Chris Bizub. So what we're sharing here today, though, is only for Private Money Club members. So I want to be very clear about this. This is not a public investment. This is not something that anybody can do. Anybody that wants to invest in what Chris and I are going to talk about today needs to be part of the Private Money Club. You need to have preferably met Chris at either the experience, one of our masterminds, our 3-day training, one of our webinars, something like that. Maybe you guys have a conversation here today, and then you need to have another phone call or two again from there. And the reason for that is just because this is a friends and family offering only. So Chris is only offering this to his inner circle, his network. Those of you in the Private Money Club, that's what it's all about, is being introduced and meeting people like Chris that otherwise you would never have the opportunity to learn about these types of investments and be involved with them. So super excited what Chris is doing right now. And this deal that he has right now and some other deals that I know he's working on as well. So Chris, welcome, man. Thanks for being here. Thanks for hopping on last minute too. I literally texted Chris. We had talked about getting him on here, and I texted him 90 minutes ago. I'm like, hey man, can you get out in 90 minutes? We had somebody else that backed out today, and he's like, hell yeah, I'll be there. So thanks for being here on last minute, Chris. I know you were flying yesterday and doing some traveling also. So what's new, man? Introduce yourself for anybody that doesn't know you.
Yeah, no, I appreciate the opportunity. I definitely know a lot of people in here. Chris Bizub, originally from Buffalo, New York, lived in a couple states and out here in Arizona now. I've been out here for about 13 years, and I've been doing real estate full-time for the last 8 years. We have a wholesaling and fix and flip business. That's our primary business. It's not a big business. It's a pretty steady business. And we got into multifamily about 3 years ago. I was wholesaling some small stuff and realized pretty quickly, while underwriting deals, that I need to be looking at bigger deals and I need to be hanging on to these deals. The potential for long-term wealth was just so evident, and I just had to start learning how to do it. I will be upfront on this actual deal. We actually closed this deal already. This deal was completed about a month and a half ago. But this is just one of the deals. We're working on other deals. We're working on bigger deals. So the presentation on this deal can really spin into the future deals with us as well. The numbers obviously will be different, but truthfully, a lot of the returns and a lot of the different numbers now in this market are pretty similar. So the returns on this deal will probably be pretty similar to other deals. They all depend on the unit sizes and how many doors we have. So
yeah, and just to kind of expand on that a little bit, a lot of what we do with Private Money Club, we've been talking about this now for months and months and months. And if you're new to this, you're going to hear it over and over and over again. But the real key to investing, especially when it comes to private money lending, are relationships. So you build that relationship. And as a private money lender, the worst day I can have, sometimes it feels like, is when I get my money back from a lender, from a borrower, I should say, because then my money's sitting and it's not moving and making me more money. So then I'm scrambling, oh, what do I do with it? But if I have a great relationship with Chris, for instance, and he's like, hey man, this project's winding down. We're going to send you your money back in 3 weeks, but we have another project we're starting up right now. are you interested in being part of that one? And then I can say, tell me more about that. And if it makes sense on that one as well, then I'll say, hell yeah, let's do that. So he sends me my money back. I immediately just rewire it right back out to the new deal with the new promissory note and new contract. Now, just to clarify on that, little education, we're never going to just take the investment and just roll it into the next deal. We're always going to complete the loop on the prior contract, on the prior note. And then we're going to, so it's just going to be a matter of wiring it back to us, just to wire it right back to Chris, or, his company, I should say. But just know that's how that works. And so, if Biz doesn't have a deal right now today available, it's relationships. I guarantee you'll have a couple weeks, because I know what they're doing right now, and he's in growth mode, and him and his partners are doing an awesome job. So go ahead, Chris.
Yeah, definitely. I mean, so a lot of the deals that we do, the multifamily deals, unless we decide to do some type of a flip on it, light renovation, turn around and put it back on the market, we will. And that's typically on the smaller stuff. We can raise money on that as well. But a lot of what we're looking at is bigger stuff. I mean, we're looking at 20 units and up right now. This particular deal is 28 units. These aren't quick turns. These are definitely longer plays. We have this thing underwritten as a 5-year hold with a first look at it after 2 years to decide on whether we want to refi and go down that route. But these are longer plays. A lot of these deals that we're doing, especially these bigger ones. And ultimately, we want people to come on the journey with us, right? You're not going to get your money back, your full investment, in 3 months, 6 months. That's not how we do these deals. You get a great return over time and ultimately double your money on the sale. And we want folks to stick in the deal with us a lot of the time. So there's a process I'll talk about through this document on our pitch deck that explains that. And I'm sure plenty of people here are familiar with it. Can I share my screen?
Yeah, you should be able to.
Okay, let me see.
Let's take a look at what you got going here.
All right, can you see it?
Yes, perfect. Meet the team.
All right, cool. So what we did is put a pitch deck together for this deal. So any big deal or just deals in general, like just fix and flips and small stuff, you don't necessarily have to put a pitch deck together. But on these bigger deals, there's so many moving parts, returns, team members, all the different things we're doing, the renovations, all that stuff. We want to make sure we put it in a really nice professional pitch deck, which basically explains everything we're doing, and then when someone runs through that, they get back to us with any questions they have. We try to answer every single thing we can. But this is the best absolute way to present a deal with someone instead of trying to sit here and talk to you through it, for an hour about every single thing we're doing. So the pitch deck is an absolute must. And fortunately for us, one of our team members, Joy, she basically builds these things for what she does on her day job. So we got pretty lucky on her putting it together.
And it's all about the team, man. Everybody's got good strengths they bring to the table.
Well, that's the biggest thing. And I know we've talked about this. I mean, just at the experience we talked about, I can't even remember how many times we mentioned the word team. I mean, it's just massive. It's everything. So I actually met my team of partners through a mentorship program I joined about 3 years ago. It's called Jake and Gino, and it is a multifamily mentorship program. And that changed my life, really. Cut the curve in half on learning. And all of my partners are from there, which is fantastic.
Are those guys out of Miami?
What's that?
They out of Miami?
They're out of Tennessee and Jacksonville. So
okay.
Jake lives in Tennessee, Knoxville. Gino lives in Jacksonville.
Okay, no worries. I was trying to think if I know them.
They're definitely an East Coast based company. They have a really, really popular podcast. I mean, at one point they were like the #1 multifamily podcast. I'm not sure if they still are.
Nice.
But really, really.
I'm just curious, real fast, Chris, anybody in the chat box that's on here, is anybody doing multifamily now, like themselves actively, or has anybody invested in multifamily, or is anybody interested in multifamily? I'm just curious, make sure we have the right group on here. Is anybody interested in learning more about multifamily investing? Because I know, Chris, I mean, we can talk about this deal you have, but you have so much experience in this, I'm sure maybe you can share some nuggets with people as we go too here.
Sure, definitely. Yeah, I got to get my chat box.
Anyway, throw your questions in the chat box, guys, or in the Q&As. We'll get this rolling as we go through this. Go ahead, Chris. Sorry to interrupt you. Go.
Yeah. So this deal, again, team is everything. There's a lot of moving parts. Everything from working with the contractors to working with the property management to doing the books to, we're running a business. This is an actual business, and we treat it like a business. This isn't, how a lot of people used to run these multifamily deals. Was a lot of mom and pop. They wrote everything down on pieces of paper and they just, let people's rents go for 7 years without touching them. The days of those are gone. We run this like a business. So the team, like I mentioned, is everything. So everybody has a role, and every one of these partners, they all live out of state actually. So I'm the only boots in the ground here in Arizona. We invest in Tucson, Arizona. That's our primary market. Really good market. Not as crazy as Phoenix. Phoenix is just absolutely insane right now. And we're trying to get more deals for our buck, or more doors for our buck. So these are my partners, man. Real quick, brief run through here. So these are the guys right here, Gino and Jake. Bill Ham's kind of my coach. Mark's the brother of Gino. These guys have been just amazing. I mean, their program's awesome. It's a very family-based program, and they just teach you a lot. There's a lot of good people in there. Property management obviously is amazing. We hired a full-time management company. We currently own 60 units total down in Tucson, Arizona. And we've switched this company over to run all of our properties for us, and they've been amazing. But they're a must. I mean, running these things by yourself, no, thank you. You don't want to deal with all that. So this was actually our first syndication deal. A syndication is basically just bring groups of people together for one primary cause. Everybody has the same interest. You bring them together for one primary cause to purchase something. Or it could be anything. It doesn't even have to be purchasing, right? You could syndicate for really anything. So what we did is raise money for this deal. Now, we were the general partners. We're the people that run the deal. We're the people that manage it, deal with the contractors, deal with everything. We're the ones that basically make this machine work and make it kick butt. Limited partners are folks that come in, they invest passively in the deal. Now, in this deal, we had a $50,000 minimum investment. What they do is they come in, they invest passively. What that does is help us buy this deal. It helps us get the down payment for the property, and it helps us raise money for the construction costs, the capital expenditures, which are the roofs, the walkways, painting the buildings, all of those things, because we have to do all that. The whole purpose of this was to rebrand this property and make it just 1,000 times better than it was when we bought it. This property needed a lot of love. So as a passive investor, you take advantage of the tax benefits, the equity gain, the appreciation, the cash flow, all of that good stuff. But you don't have a say in the property. You don't have a role in the property. You are a passive investor. You sit back and you collect a check every month or every quarter. And we update folks every month or every 2 months. We're going to update everyone on the team. Hey, this is what we've been doing. These are what the numbers look like. And then if people have input, we'll take their input, and we love to listen to what everyone has to say. So it's a really good deal for folks that have a W-2 or are running other businesses, but they have some money laying around that's gaining nothing in the bank. Obviously, we know that. Stock market, I'm not a big stock guy, but I know that's been all over the place. This is a very secure place to put some money and just get gradual cash flow through it. And eventually, we'll get into a little bit later, where you can stick with the team and run with us for years and years and years, ultimately growing. Here's another part. What is a syndication? Contribute to capital asset, completely passive, no daily responsibilities, limited liability, little control over the business. Then you see the general partners, we do everything. And we've been doing this for going on 3 years now. We've been highly successful with our other 2 properties. Our first property was a 24 unit down there, and we hit our year 4 numbers in year 1 at the end of Q4, which is just incredible. And so we're highly confident in a lot of the deals right now that we're doing. Executive summary. So what this was a 28 unit apartment complex. It was a mix of 16 2-1s and 12 1-1s. We ideally look for 2-1s. The Tucson market is very limited on 2-1s unless it's a newer product usually. So we got pretty fortunate with the unit mix on this one. We purchased this one for $2.5 million. The down payment was $850. Capital improvement budget was $375. Closing cost obviously $70,000. Acquisition fee $50. So when you add all these numbers up, we get to about 1.3. Our goal was to raise 1.35 on this one just to be safe. We got there. We got that done. We actually overraised by about $250,000, which was really, really cool. And what we did is we just reached out to friends, family, relatives of relatives, and then investors in our network. And we ended up getting it done over raising, which was amazing. We had some challenges on this one with the bank and a few things with our LLC, but we ended up getting it down to the wire. The structure on this deal was an 80-20 split. We kept it really, really simple on this one. So the limited partners, all the passive partners, they get 80% of the profits divided up, but how much you invested. You invested 50,000, 100,000, whatever your amount that went in was your percentage that came out of that 80%. The 20% is the general partners. That's what we get for running the deal, managing it, doing all of the hard work. So it's a pretty good deal here. We try to be, obviously, we want the limited partners to really benefit. We wouldn't be doing deals if it wasn't for them helping us get there. The business plan on this one, and I'll get to some photos and stuff in a little bit. The business plan was renovate 85% of the units over the 5-year hold. This was a 5-year structure. And the reason we only do about 85% is because we want to leave some meat on the bone for the next investor. So when we decide to sell this property, there's at least 5-6 units left, and maybe a few other things there that we didn't touch on, that when they go to buy it, they say, hey, listen, there's a little bit of value add here still. We can raise our NOI, we can raise the value of this property because there's still some meat on the bone. We're not selling them a fully renovated, B+ class property. Rebrand the property was a big one. This thing had really bad reviews. The last owners didn't take very good care of it, neither did the property management. So we eventually are going to rebrand it, new name, everything. Increase the rents to market rates. Most of them are not market rates. Again, we're running this as a business, so it's going to be market rents or higher if we can get it. Optimize operations with the property management, decrease expensive. There was a few expenses on this property that were very high, and so we're getting those under control as well. And then we do something called RUBS, which is a utility bill back program, and we bill back the tenants for so the water. They put electric in their name, but the water consumption, sewer water and trash, we actually end up billing them back for that. So we charge them, I think it's $30 or $35 a month. So that's huge for us. Instead of us taking on that expense, we could bill it back to them. So here are the returns on this deal. Now, in this market right now, you'll see that these are pretty standard returns. They fluctuate here and there. Definitely standard returns for a hot market, a bigger MSA. And Tucson is definitely one of those. We're a little over 1 million population, and that market's just cruising. It's kicking butt. It's been number 1 and number 2 for the last 4 or 5 years in rent increase. This is an average annual return of 18%. So that's basically your overall return on this deal is an 18% return. IRR, I don't really want to get into that. That's kind of a complicated topic. The average cash on cash return, though, the 6.7. So this is very conservatively underwritten. So you're going to get a 6.7% return on your cash that you invested in this deal. We believe by the end of year 1, we'll be over 7% on this one. All of our other properties have been. They've, done very, very well. And we pay quarterly on this as well. And a 1.9% X multiplier. So when we sell this deal, again, it's structured as a 5-year hold. And we'll look at it in about year 2 and say, hey, how's the market doing? Should we consider a refi? This property is kicking butt. Market's still really good. Rates aren't hopefully over 6% in 2 years or wherever they're going to be. When we decide to sell the deal or refi, you get a 1.9x multiple. So say you invest $100,000, you're basically going to get $100,000 back. It should be a double X by the time we get to the goal of all of our underwritten numbers. And so you'll get your money throughout the deal and you'll double your money on the sale, which is fantastic. And you take advantage of all the tax benefits as well, which I could talk about in a little bit. Here's all the numbers. This is our underwriting. I don't want to look too deep into this one. Obviously, this can get a little crazy, but you can kind of see here, we have it broken down into years, year 1, year 2, year 3, year 4. Year 1's obviously a tough one. Year 1's tough for almost any deal you get into. Big multifamily deals, it's the restructuring, it's the rebranding, it's the kicking tenants out, it's the bringing tenants back in, raising rents. So year 1's usually, you'll get a return on it, but it's nowhere near like year 2 will be. You can see the jump here from 239 up to 291. I mean, it's a pretty big jump. Here, okay, so some more on the projections. This is all based on a $100,000 investment. So if you look at some of these numbers here, it's pretty easy to break down. Again, you see your total return 192,878 there. The projected numbers, again, conservatively underwritten. We really realistically feel like the upside of this deal is right around these numbers right here. So we're going to strive very, very hard to get there. And I believe we will, especially with our property management company. They're really, really kicking butt. And then we also stress test these deals. So we put them in there for underperforming. You know, we underwrite these deals sometimes with 10 vacant units and, you know, rents going down and the market shifting. And we really just stress test these deals through the underwriting. And so this is kind of the underperforming numbers here, which are still good numbers. This deal will still survive. We might make a couple dollars, but we'll have to stick it out until the market does its little turn, comes back to us. So either way, we wouldn't get into a deal unless we either stress test it and looked at the big time pro forma and realized we got some big numbers ahead of us. Let's see here. We'll go through this. So again, here's part of the business plan: renovate 85% of the units, remedy all the deferred maintenance, which this property had a ton. I mean, we just finished all the roofs. We had to redo the second story walkways. They were just destroyed. People, their feet were almost falling through in some areas. I mean, it was really bad. Rehab the property. So we'll just do unit turns and update the laundry room and a few things throughout. The pool we have to do at some point. Lease up to market rents again and decrease operating expenses. So a few ways we do that, I believe on this, nope, not this one. Decrease operating expenses. So number one is the rubs that I mentioned. And over time, what we do is we put in green friendly toilets, shower heads, things like that, so that they draw less water out of the property. So we try to put as much of that stuff in there. And you also get a tax credit from the state on that. I'm sorry, from the county. We did it on our first property and we're actually still waiting on that tax credit, but we're told we're going to get it.
You guys do like LED bulbs and things like that to reduce electricity, or?
Correct. Yeah. LED bulbs, even our laundry units, like we're swapping out the units to get more efficient units.
Right.
Yeah. LED like throughout the entire place. I mean, really just anything we could put into the property to ultimately drain less juice, you know, less electric, less water, and which is also less stress on the property and less stress on all the utilities. Yeah, we do everything LED on all of our properties.
Cool.
So yeah, business plan renovations. So this is these are some of the units. This is the exterior right here. Again, it's a 28 unit building. Pretty nice size. And actually, it's funny. It looks from the pictures, it looks a lot bigger than it is. But this is basically, these are the units right here on the left, really dated. This is actually a 1981 built property. And so most of the deals we look at, we try to be 1970 or newer. And the reason for that is really obvious. It's electrical, it's plumbing, the way they were built. We try to get things that we don't have to go in and do the plumbing a lot of times. So we have to update the electricity or any of those big ticket items. Those items add up really, really quickly. So this was an 81 built. So we got really, really lucky. But of course, in the 80s, they didn't have the fancy stuff we have today. So, you know, you got your dated units over here on the left. This is some of the exterior right here. Deferred maintenance, capital improvements. The capital improvements are typically they're all really big ticket items to keep the property functioning and keep it safe, as you know, roofs, landings, anything structural in there that needs to be taken care of. Those are we basically call those the big ticket items. They're the really expensive things. And the goal on this one is to put about 6,000 per unit. We've actually gotten estimates. We've already rehabbed 2 units and we came in at 4,500 on both those units. So we're already saving money on the turn, which is great. Some interior renovation plan. Now these ones on the right over here, these are actually from our 24 unit that we have. This was one of the higher end renovated units we did. We did all the cabinetry on it. This is a 550 square feet unit, 1 bed, 1 bath. Small, cute, but these things rent like crazy down there. And so this is typical turn that we'll do here. The property on the left, these units, we're actually not going to be doing tile. We're going to be doing the vinyl flooring. The vinyl, either the rolled or the plank flooring. Our other one over here had all tile throughout, so we're going to keep that. Yeah, we'll get rid of all the carpet. Any of the cabinetry that looks really, really dated and beat up, we'll go in and refinish it. Any of the cabinetry that's really, really beat up, almost not savable, we'll go ahead and just replace all of the cabinets. And when we do that, we typically make that one of our higher end turns. We'll do either Formica, like a nice Formica countertop in there. We'll do the appliances, all the hardware, everything we update and try to go for a higher end unit. We call that like the gold package is what we like to call it.
Yeah, that vinyl flooring they have nowadays is nice though.
It is nice. Yeah. It's so we either do like our property management tries to push the glue down on us a lot. And it's good for replacing sections. It's easy instead of taking out all of the flooring, but it's a really big pain in the butt to install. So we've been trying to go more toward the plank lay down, the floating style. But yeah, it's really nice. I mean, it's stuff, strong stuff. Again, here's the other one, just kind of an example on this one, just a case study of how we've been doing. It's been extremely successful. I mean, rents on this one were $560 with $30 rubs. You can see over here, we got that up to $795. We actually just rented 2 units out at $850, which is amazing. Just absolutely blowing the numbers away that we thought we'd get.
For rubs?
Well, not for rubs, for the rent.
Or what are rubs though? What is rubs?
It's called utility bill back.
Okay.
And so what you do is so on a lot of properties, the water bill especially is something that the owner pays. It's got one water meter on it. Now you could go in and subdivide all those meters and get that done and then put their own utilities in their name. It's kind of expensive. So what we do is we just take one big bill and then we bill it back to them. Now it's an actual program. It's not something we structured. It's an actual program that you have to use. And we bill back the tenants $35. And so every month we get that bill, we bill them back, we get compensated for that bill. Yeah. And typically we make out on it. So not heavily, we're not making thousands of dollars on that by any means, but it covers our butt.
Right.
And then it makes people more conscious. It makes tenants more conscious of how much water consumption they use, electricity and those things. Hey, I'm getting a bill every single month, even though it's a flat fee, it still helps them be a little bit more conscious about it. Hopefully. Business plan optimization, partner with our experienced property management. Like I mentioned a couple of times, these guys have been kicking butt down there. They have over 3,000 units they manage. We're hoping to grow with them. And so far, everything's been pretty good. This is what I was talking about before, the implement water conservation plan. So we install the low flow toilets, shower heads, and faucet aerators, dramatically reduced in-place utility costs. Again, this is it's good for utility costs, and it's also good for the buildings and the plumbing, all of those things. It really puts less stress on them. And then this is the utility bill back program we just discussed. Let's see. Business plan again. Renovating a lot of the units immediately. I think we're doing about 5, right? We did 2 already. We got 3 more coming up. We finished the roofs. The landings, which are the 2nd story walkways, those are being worked on as we speak. Rebranding probably around Q2. We had a couple folks tell us to do it right away, but we're trying to shift away from the clients, the tenants that we have in this building, the clientele, and getting to a different tenant base. The old owners really allowed, and there's nothing against this tenant base at all. It's just we have a different business plan. And we're trying to shift to a business plan that is less programs, if you will. We're not going to allow as many programs, your Section 8 and all these different programs that they have. We're trying to really kind of switch this area up a little bit. And so we will be rebranding it at about Q2 because we wanted to make sure that as we started moving tenants out, I mean, we actually just found out 2 weeks ago we had drug dealers on the property and people were sneaking onto the property through one of the gates and buying drugs and sneaking back off. I mean, there was a lot going on. We had to actually have somebody watch the property. And so we decided to wait a little bit so that while we're moving these tenants out, they are not posting reviews on the property or, however they do it online about the rebranding name. Mm-hmm. We wanted to make sure that they did it against the old name. We get those people out of there. And then once we come Q2, maybe even creep it into Q3, then we'll rebrand the property because we know we've pretty much gotten rid of, the problematic tenants and the potential tenants to really it's about the reviews. We want to have really good reviews on this property. I mean, it's just like, Airbnb, VRBO, or any business. People, everything is about reviews now. And we don't want that on a new brand.
Yeah, it makes a lot of sense. You're just going to be in that little no man's zone where you're advertising for new people before you rebrand while you're getting the old people out and try not to have too many vacancies.
Yeah, for sure. That's the big thing. I mean,
22.
yeah, it definitely is. And while all of that's happening, we want to make sure it's still happening under the La Paloma name.
Right.
We're going to end up calling this the Landings on Second. It's on Second Ave, so we'll call it the Landings on Second. It's a lot harder the two hardest things with apartments and buildings and all that is deciding on a new name and a new paint job. It's the hardest thing. 5 of us couldn't figure it out. We're going nuts. So let's see here. So here's the timeline, like I mentioned. Hold on, I got to try to get rid of all this stuff here. There we go.
When you're going through this, so when you're looking for deals, like when you're looking at new deals and thinking about putting one together, I guess this is kind of like your process, huh? Like you think about each one of these steps along the way. What's it going to be in renovations? How do we fix it up? What's the overall plan going to be, right? Is that kind of what you guys go through when you have meetings and stuff?
100%. I mean, before we ever even got our first deal, we were having phone calls twice a week, talking about how we were going to do this, how we were going to plan, what we were going to do, structure, returns. I mean, underwriting. And this goes back to 2 years. And so now that we have a lot of deals, we get together every single week and talk about all these things. And then when a new deal comes, soon as we get that deal, whether it's via the off-market acquisition stuff that I like to do, or it's from a broker, soon as we get it, I mean, we have like 3 calls a week every at night at 8 o'clock at night, and we just break down every single thing we can about the properties. You have to do it because there's a lot of money in these deals. You want to make sure, especially when you're putting together these decks and everything, you want to make sure you've crossed everything. Cross all your T's, dotted your I's, and you really know what you're doing. Let's see, we have capital improvement budget. This is a few of the things here. A lot of this is just really explaining kind of what we were going to do. Roof work, landings, water heaters, evaporative coolers. So a big thing in Arizona, especially in Tucson, is we have evaporative coolers down there. We have AC, of course, and evaporative coolers, but evaps they're so big in Tucson. And this property actually has all evaporative coolers on it, which is basically just recycled air, cooled air, water. There's water.
They call it like swamp something.
Swamp coolers.
Swamp cooler. Is that exactly what they call it? Same thing?
Exactly. Same thing. Evaporative cooler, swamp cooler. And it's just basically air cycled through water to cool it down. It's not the greatest, but it does work. It cools it down, and people in Tucson are pretty used to it. Unit upgrades, probably spent about 132 on that. I bet our numbers will probably be more around the $90,000 mark, the way things have been coming in for us, which is great. Appliance 36, exterior paint 30,000. This actually, we're getting the apartments paint. We got an estimate for 19 grand. So, I mean, a lot of our numbers have come in a lot lower. And when that happens, that's more of a kickback to the investors. When we have savings, everybody's in on those savings. See property overview. So this is the property overview. This talks a little bit about the market, the property, returns, expected returns you can see in Tucson. Again, it's 28 units, 12 one beds, 16 twos, 81 build, occupancy 30 or 93%. Tucson is very, very pocket specific. It's big, but it's not huge, and it's very pocket specific down there. And this is located just south of a pretty prestigious area. So we're like right on the cusp. And probably over the next 2-3 years, we think that area is going to keep shifting south. And so ultimately we got into this thing for $89,000 a door, which is really, really good price right now down there. They're typically trading for about 100, 105. And so we're just going to slowly do what we can down there and help. We even talked to the police down there. I talked to them about 2 weeks ago and just said, hey, man, we just bought this. This is what we're looking to do. Can you guys keep an eye on this property? Really just trying to talk to many people as we can to know, hey, we're down here. We're active, and we're trying to clean things up, if you will.
Yeah, that's good, man. Find something on the verge right there. And, as expansion happens, you'll be part of it. You pick up discounts that way.
Yeah, we're hoping so. I mean, There's a few things that probably won't leave that area that kind of affected. There's some, small car dealerships and a couple other items over there, but it's still going to travel south. I mean, there's a big new development actually going on just across the street. So we're pretty excited about that. I think it's a mixed use that they're doing. So here's one of the units. This is actually one of the cleaner units, dated but clean. You could still rent this unit for market rents all day. You don't have to take a haircut on a unit like this. Supply and demand is really big down there. I mean, housing everywhere. We know there's a shortage down here. There's definitely a shortage of units and clean units as well. Here's another one. It's got some vinyl flooring in it. You can see that. That's the rolled flooring. This one this is the one we're renovating it right now. So this one was kind of renovated, but it's one of the better units. So we're going to go ahead and do the cabinets and a few items on there. This is the exterior of the buildings. Put together a really, really cool paint scheme for this.
Do you charge different rent if one's like not completely redone or one's like all brand new with high end stuff? Yeah,
we do. Yeah. So we have to put it simply, we have like the silver, gold, and platinum packages. That's just kind of like the way you talk about it in the all apartment owners. That's just the way they have different names, but that's what we'll call them. And so the silver is just your basic unit, right? Super clean, painted, very, very basic updating. We basically call them market ready units. And those will be kind of your market rent or a little bit below. Your gold unit is a little bit more updated, and we might have done the cabinets, some nice flooring in there. That typically will be a little bit over market rent. And then when we go for the platinum package, which is typically everything, we'll renovate, we'll do all the cabinets, newer appliances, stainless steel appliances, nicer flooring, nicer lights, all the items that really make it just a really, really nice unit. And typically we'll charge a little bit more over that market, that middle unit, because we can. It's a nicer unit. Doesn't have to be at market.
Cool.
Which ultimately brings the NOI up, really, really raises the NOI on it.
All right.
A couple more pictures of this one. And then here's a little bit about the Tucson market. Unemployment rate's been going down, which is amazing. Medium household income is about 53,000. Employment rate's 4.1. Number 2 in rent growth. 2 years ago, it was number 1. This year, I think it's like number 4, 2022. Average price per unit, again, is 108,000. So we bought in really well at 89,000. Why Tucson? We have a strong team down there. I've been fixing and flipping down there for a couple of years. We've been doing some wholesale deals. I've just made really, really good connections with folks down there, and it's just a killer market. It's just behind Phoenix. It's growing like crazy down there. A lot of white collar stuff's happening. A lot of tech stuff is happening. The school's expanding, which is University of Arizona. A lot of military, just a lot of really, really good things happening in Tucson. And originally about 10, 15 years ago, Tucson was a place where you went, you worked, did your job, and you left. Or you went to U of A, did your 4 years of schooling, and then you left. So it was really hard to keep people in Tucson. There's been some new folks in the government there, and I think they have trying to remember the guy's name, but he's really come in and is ultimately trying to keep people in Tucson, and they're doing a really, really good job of that. Local expertise, that's me. Been doing it for a long time down here. Job growth, population growth, like I said, it's really been kicking butt. A lot of companies are expanding. And Arizona is really, really friendly for businesses, really business friendly. Really good, tax benefits and all kinds of advantages for having a business here. So a lot of companies come here. Rent growth and appreciation, of course. Vacancy trends. Kind of boring slide here, but take a look at it. There you go. So here's a good rent trend. This is a big one that people follow in our space. I mean, this is massive. This is where, a lot of your hedge funds right now, a lot of your iBuyers, they base a lot on this right here, these rent trends. They're buying and scooping up every property they can get their hands on, and they're doing it in really hot markets because the rents are just going crazy. Obviously, that's not amazing for renters, but we can't do much about that. It's just the economy and it's how things work. So here you go with Tucson, number 2, which is amazing. Job growth. Here's some of the things, some of the big employers. So we always put this on here. We want to make sure people know that, hey, when we're looking at deals, this is why we're looking in that area. There's a lot of jobs, there's a lot of expansion, a lot of big name companies. I mean, Caterpillar's headquarters is down there. Raytheon Missiles is just massive. big aerospace down there in Tucson as well.
Yeah, and on that a little bit, when you're looking at real estate, all that growth, all the advantages for businesses, that's all stuff that you want to look at when you're investing. Because if we do see a turn in the economy, the market takes a shit, the economy takes a shit, whatever happens coming up in the next several years, if you're in a place where people need to be because of jobs, because of those reasons, I mean, that's when you really need to be somewhere strong. It's good to own real estate there because those are the markets that'll take less of a hit. If you're in the middle of, no offense, somewhere like Alabama or something like that, in the middle of nowhere, Kansas or something like that, and the economy takes a hit, your local economy is going to keep chugging along. Maybe you don't see a lot of craziness going on, but do people move away because there's no jobs? Are they forced to go other places? Like, what happens? So owning especially multifamily in places that have that strong growth, that have that strong foundation like that, is very important when we start coming into the times that we might be coming into here soon. So that's all very positive stuff that I'm looking at. And, we'll talk more about the syndication stuff and that in just a minute, but that's all stuff I'm looking at, man. It's all good stuff right there, Chris.
Yeah. And I will tell you, like, these markets too, a lot of these markets, they take a big hit when that stuff happens, right? There's a lot going on. And, back in 2008, Phoenix, Florida, Texas, they got hit really, really hard. Tucson as well. And so these big markets, they will take a big hit, but they also recover really, really fast.
Well,
Now,
the single family markets did. If you look at data from multifamily never took much of a hit, especially when it comes to the rent prices. Rent prices stayed pretty level, and maybe the equity went up and down, but those rent prices stayed pretty level in multifamily back then, and because of that strong foundation,
they actually went up, which is insane. So, but it makes sense because people were losing their homes, they couldn't afford their homes. I mean, they're $4,000 payments that they should have never had in the first place. So, multifamily definitely is one of the most recession-proof types of real estate, because you could lose 8, 9 tenants if you have a 40 unit. You're still covering your bills. Even if you lower the rents, I mean, you still are covering the debt service on it, the mortgage and all the utilities and the things that you have to pay for. And so you just have to stick it out, right? You just have to weather that storm. You have to wait a little bit and let it get back to where it's going to go. It's a cycle. It's always a cycle. It's always going to come back. And so that's why multifamily is great. People always need a roof over their head, right? They always need a roof. And multifamily actually the rents went up during that time, which is, you wouldn't think it, right? But it did. So, but yeah, so a lot of these like Midwest markets and stuff like that, they didn't get hit as hard as a lot of these bigger markets, but ultimately they're not as, you're not going to get the rents and the things that you're getting in a lot of these other bigger markets. So, it's all your flavor. It's all where you want to be. It's all the type of investment you want to do. And, we prefer the bigger markets. We prefer where people really want to be and invest their time.
Well, here's the other cool thing with the syndication too with you guys is you can talk about what the strategy is. I mean, I know you have your plan to look at the market in maybe 2 years from now. Let's cash out in 5 years. We're expecting a 1.9 to 2 times, return at that point. But let's say the market does take a hit. Let's just say real estate prices drop in half, which I don't see that happening, especially in a place like Tucson. But let's just say this place falls in half, the market value of the actual complex, right? So in 5 years from now, let's just say, hey, you can't sell and double your money. So you have that discussion. Listen, we're still making money. The rents are still up. We're still making 6-8% returns. So do we keep this going and wait for the market to go back up? Do we just sell and kind of say, let's just move on to the next deal? And not necessarily going to lose money if your 1.9 to 2x multiplier drops to 1. Maybe you get your money back. You still were making 6-8% on your money during a time when the economy is shitting itself, when the stock market fell in half. And then, or, do you sell it, or do you just hold on to it for another few years? Because think if you bought in 06, you lost it, you lost half the value in 08, but you held on for 6 more years, the price went right back up. I mean, by 2015, we were back up there. Look at where we are now. I mean, this thing's probably double what it was in 2006. So it's just, so you have that flexibility of what do we do with it? Do we need to cash out? And so there's just so many options on it too. And correct me if I'm wrong there, Chris, but that's one of the things I like about this kind of stuff too, because you're still making money. You're not losing money.
Yeah. Yeah. And again, that's why we stress test the deals when we underwrite them is, hey, if we never know what's going to happen, right? I mean, we've all talked about this and we're hearing it a lot right now. Nobody has a crystal ball. Like nobody. We can see the things and we can pay attention to history, but you really still don't know. So we stress test it definitely to know like, hey, if something does go down in a couple of years, this is kind of where we're at. This is the threshold, the break even point. And so we definitely do that as well. And yeah, again, that's the great thing about multifamily. Even if you have to lower rents for whatever reason, even if you have to do concessions for people, you can get hyper creative on, with tenants and keeping the property afloat. But ultimately, you want to keep that property right there, right? The goal is to never lose a single cent on these properties. And fortunately, because the higher the units, especially, people just need a place to live. You just got to get creative, and you got to weather the storm if the storm ever hits. And that's the best part about multifamily. It's not a single family. And you lose a tenant in a single family, you lost a tenant. Like, now what do? You're paying for everything. On this, it's we lose 2, 3. I mean, right now we have 4. I think we have 4 vacancies because we're renovating units. We had to kick these drug dealers out. So we have 4 vacancies, and yeah, we're not making as much money, but we're not feeling that. We're not sitting around like, holy crap, how are we going to cover this bill?
Right.
Yeah.
Yeah, man, it's a wonderful thing.
It is. Yeah, it really is, man. And we're growing. We want to get more doors and bigger doors. What we realized, the difference between an 8 unit and a 28 unit wasn't much. There wasn't much there. Obviously, we syndicated this deal in 8 unit. We wouldn't syndicate, so there was a little bit more on that side, but there wasn't that much of a difference. So for us, it's definitely about trying to grow right now.
I'll kind of sidetrack you. You have somewhere next to go though, right?
Yeah, I didn't know if we wanted to get up to the syndication stuff. Can't remember where I put it, but
yeah, I'd like to, because we haven't really talked about syndicated deals on here much. I mean, most of the deals, like Rob Fuller, you met in Georgia. He was on here right before we went out to Utah, and that's a direct lending deal essentially. So you're basically the bank on that deal, where you're doing just like the bank would do, and you're lending money through a mortgage and a promissory note. So it's pure debt, right? So what that means is there's set terms. You give him $100,000, he pays you 12% annual returns, with interest paid monthly at the end of whatever that term is. I think in his case, it was like 13 months or 18 months, but more than likely 13 months, you're going to get paid back. And that's it. Gives you back the 100 grand after he's been paying you interest the whole time. The deal's done. You move on to the next one. If things go wrong, you can foreclose on the property and take it over just like the bank can. That's it. In a syndication, you're true partners. I mean, there's the general partners and there's the limited partners, but you're still partners on this deal. So Chris and his team are going to be taking care of all the work and making all the decisions and everything, but you're still a partner in the deal. So you're there for the highs, you're there for the lows. If you guys quadruple your money, you quadruple your money. If you guys break even, you break even. And if the property's doing well and making nice rent income and you're making 6%, you're doing that. If you're making 8%, you're involved in the deal every step of the way, the pros and the cons. And so that's really the biggest difference in the two. And there's obviously advantages and disadvantages to both. So it's just kind of a matter of, but that, if you guys are doing this right, Chris, you guys have the experience now. You've been doing this for a while. Looks like you're getting better and better at it. And like you said, I mean, if you can double your money at the end of the day, do you want to take that on and go that route? So, what we like doing here, especially why I was super excited to have you on, Chris, was just to talk about syndications a little bit, because we haven't really talked about it in the past. And I'm a fan of them. It's just a little bit different. And I just want people to kind of realize the differences. But that's what the private money club is all about, right? Is having those differences, whether it's a private fund, a one-off deal, a lease option, long-term, whether it's the flip or a big multifamily syndication like this. I mean, like to have a little bit of everything. So but if anybody has questions, throw them in there. We're going to answer those, but keep rolling, Chris. This is great.
Yeah, I haven't looked at the chat, by the way. I've been just kind of talking.
We're good. We've been hitting.
I'll get sidetracked really easily if I look at that.
Yeah, one question for you though, I will hit. When you guys bring on limited partners, do you have like a minimum amount that you want somebody to have?
Yeah, we do. It's 50,000.
Okay.
And the reason for that being is, well, there's a couple reasons, but number one, it's, ultimately you want to get a good return out of this, right? You want to see the money. You want to really, really see a return coming from this deal. And if you're doing anything, you're investing 10,000, 15,000. Unfortunately, you're going to get a return, but it's not going to be worth the timeline, if you will. Right. So we try to have 50K minimum. Number one, because we want to make sure that, whoever's getting in the deal, they have, they got the money, they got the experience with investing potentially, or at least they know how to understand. They understand money, right? That's a big thing with the syndications. You got to bring people in that understand what they're doing. They're not giving you their last $50,000 and they have $800 left in their bank. We don't want that. We do not want that. Yes, this deal is going to be great and kick butt, but we also don't want to take all of your money. So, we interview everybody when we get investors and everything, but and then ultimately because of a syndication, you want to start at that 50K on a lot of these deals because number one, writing, doing all the tax returns, huge pain in the butt. If we have people investing 5,000 here and 5,000 there, next thing you know, you have 50 people in a $2.5 million deal. It's not enough for everybody because it doesn't make it worthwhile. Now, if it was like a $50 million deal, that'd be a little bit of a different story. But yes, we do a 50K minimum on the deal, specifically for that reason. So, not that there's less investors, there's just less moving parts, if you will.
Yeah, it makes sense. And of course you can do more than 50 if you'd like to.
Yeah. Oh yeah. 100%. So most of the people I think we had 14 investors passively. We also, all the general partners invested in the deal. Because as a general partner, you get 20% the way we structure it, 20% split up by 5. There's 5 people in this general partnership, which is kind of a lot. Typically you want like 3 or 4, but we're just trying to grow and everyone wants to do deals. So we brought 5 in. So the return on our end actually isn't amazing. So we invested in the limited partner side as well, so that we get some of the general partnership and we can get some of the limited and obviously help raise the money for the deal. We had 14 other investors in it. Everyone was 50%. I think we had 3 or 4 people that did 100,000.
Right.
So it worked out pretty well.
Very cool.
And this was so in syndications, you have 2 different structures. Actually, there's multiple structures, but the 2 main ones is a 506B and a 506C. And the 506B is a friends and family structure. So I can raise money from all friends, family, relatives, fellow investors, but the law says that I have to know them. I've had to have met them multiple times. I've had to have conversations with them. They're not just somebody randomly off the street. I'm like, hey, you want to invest 50K into this deal? There has to be a 3-touch minimum, they say, of communication, whether it's text messages, phone calls, emails, even through Facebook, or we're friends on social media and they've seen we've talked and we've been friends for years. Maybe I think that can happen as well. But I cannot present this deal on social media. I can't send this deal out on platforms, things where people will see it that I don't know. I cannot present this deal like that. It has to be presented via our network, our close network. The 506C is a little bit different. That you have to be an accredited investor for a 506C. And you have to have a net worth of $1 million minus, or not including your personal residence. And you have to earn, I can't remember if it's 200,000 or 250,000. It's one of the 2 per year for 2 consecutive years. And so that considers you a accredited investor. And when you structure it that way, I can present this deal any way I want. I could put this deal on social media. Obviously, it has to be done right, but I can put it on social media. I can put it on different platforms and present it to really anybody. I can grab the Joe Schmo off the street. I got to find out if he's an accredited investor, obviously, but I could say, hey man, I got this deal. I got this really great property we're doing and want to see you invest in it. So those are the 2 main structures that people see right now. There's bigger ones, obviously, for much bigger deals, but those are the ones that we see in multifamily primarily.
Yeah, and that's why this Money Club Mondays is not advertised publicly. It's invitation only. The Private Money Club is a private membership. You pay to be a member of it, so that way we can introduce deals like Chris has here, and you don't have to be a accredited investor. Maybe you're just looking to take back control of your money. You started a self-directed IRA. You've opened a banking policy. You don't believe the stock market is going to keep running and growing the way it's going to be, and maybe you think the stock market might actually come down. You can't have your money sit because inflation's going fucking crazy right now. So you got to keep your money moving. Maybe you don't have time to actively go out there and buy deals like this yourself because you have a full-time job, you have a family, you have responsibilities. So how do you find stuff like this? How do you get introduced to deals like this? That's what the Private Money Club is all about, because otherwise, if you're not accredited, how do you learn about stuff like this? Like Chris said, it's illegal for him to approach you and tell you about it otherwise. And that's why these kinds of clubs like this exist. And so it's I'm a big fan of the B, like you guys are doing, Chris, because of those reasons. You don't have you don't do the public advertising, which who wants to deal with the public anyways? We want to be
Right.
friends. Like I have a feeling most of the people that are going to invest in your next deal are going to be people you met at the experience mastermind, you went snowboarding with or zip lining with, people that we've talked to at the other events and things like that. So it's I love the way you have it set up and structured. And so answer this for me, Chris, just so people know what to expect. So with a direct lending, you guys are all becoming very familiar by this point with mortgages, trust deeds, and promissory notes. So what does it look like? What's the paperwork? What's the contracts? What's that look like with the syndication deal?
So definitely different. There's no promissory notes or anything like that. So what we do is we create an LLC for the property, and then we create a management LLC. So we have two separate LLCs, and when people invest in the deal, I mean, we have I don't even know how many pages the syndication agreement is, but I think it's like 47 pages. Like it's a lot of pages. And so it's very official paperwork. Our attorney drafts up, our securities attorney, but there's no promissory notes or anything like that. You're not lending us the money. You're lending the LLC the money to the property, right? You're an owner of the property. So you take the advantages of owning the property, tax benefits and cost segregation and all the things that we're going to do to the property. And so it's a little bit different than just lending. Hey, I'm lending to a bank account, give me a promissory note, and here's the return I'll give you. So yes, the paperwork is a lot different. Fortunately for me, I don't deal with that side of things. My partner, Mike, deals with the syndication attorney and does all of that. We obviously all review the paperwork, read through it, and we all have to make sure everything on it looks really good. But fortunately, I don't have to deal with that, which is great. But yeah, the paperwork's completely different. I mean, it's you're investing as an owner into us and into the property.
Right. Yeah. So, this is something you got to keep in mind too. You're going to have this on your taxes. So maybe that's a good thing for you. Maybe it's a negative thing for you. It's probably a good thing, especially if you're looking for some deductions and things. I mean, you're going to see quite a few write-offs and things in the early years, right, Chris?
Yeah, the first year. So we do on these bigger deals, it's called cost segregation. And basically what that is properties have a life value, if you will, of like all the items on there, the fridges, the stoves, all of the things. And they say that it's 27.5 years for multifamily. And so in 27.5 years, all these things that you have on the property are eventually going to fail. They're going to wear down. Everything's going to be, roofs, all that stuff. And so with a cost segregation, you're allowed to actually take that tax deduction in year one. And so they send somebody out and they come in and they do a whole entire evaluation of the property. And so what we would have taken in 27.5 years, we could take in year one, which also gives us a tax deduction. So you could take that in year one. All of us will take it. The general partners, the limited partners, everybody will get a K1 for the year, and they can use that deduction towards writing off on their taxes, which is cool. And you could dig more into that if you ever want. Look up cost segregation, how that structure works. But it's really, really cool. And we're hoping that sticks around. That was a big thing in the Trump era, and it was very favorable to real estate investors and people that own real estate. So we're hoping that sticks around for a long time.
Yeah, big money in this, so I could see that's not being taken out.
Right, and we're providing living for people, right? Like, I mean, ultimately our goal, yeah, we want to make money and do that, but really we're creating communities. We're creating places for people to live, call home, safe, friendly environments. And the government in most places takes kind to those people who do that, especially in Arizona. They're really, really good to us for coming in and creating these communities and providing housing for people.
All right, cool. I mean, so let's see, we went through that deal, kind of syndications, paperwork, taxes. So what do you, and so just if you hopped on a little late, this deal is actually already funded and closed. So this is kind of we were just kind of talking about an example. I wanted everybody to meet Chris. He's been around money school for a while now. I mean, I know you've known Chris from other masterminds. Chris Naugle from other masterminds. So he's been around our network for a while now. He's just getting more and more active on the private money club side. So we were hanging out and snowboarding out in Utah a couple weeks ago. So let's just get you on the show as soon as we can, so people can start introducing and meeting you and things like that. Because Chris is going to be a big part of Private Money Club. He's going to be bringing a lot of deals to the Private Money Club. So I want you guys to start to get to know him and again, start having these conversations. So if you guys want to reach out to him, email me and I can connect you with Chris. Or if you want to reach out to him directly on Slack or on the Private Money Club, maybe just have a phone call or start sending some text messages back and forth. Start developing that relationship and that contact. So when he does have that next deal available, he not only can, send it right over to you, so you'll be one of the first people involved, but also the legal requirements are all taken care of. So you guys now can, legally do these deals together, which is always a nice thing. So reach out now. I mean, even though it doesn't have a deal available, but maybe tell us, Chris, what are you guys working on now? Are you having any, are you just looking at properties? Do you have anything you're making offers on right now? Or what's that kind of look like?
Yeah, I mean, we're always looking at properties, definitely. I mean, whether it's off market or via some of the brokers down there that we stay in contact with constantly. This deal came from a broker. Our first deal, the 24 unit, came from a letter I sent. It was, nice, Hail Mary on some letters, and it actually worked, which is great.
Awesome.
But yeah, no, we're actively always looking at deals. We just funded this deal, so this deal was primarily friends and family. I think we have maybe 2 other real estate investors that were through the network. So a lot of the team members have kind of tapped out their friends and family on that side. So now we're always looking at deals, but we're actively always looking for investors. We're always looking for money. That's truly the only way we can get these deals done. And we can look at properties all day, but if we don't have the relationships and the money and the folks that want to get into these deals with us, we're basically just underwriting deals and wishing and hoping we could do something with them. So actively always trying to raise money and find partners. And the touches, like you just mentioned, that's the big thing. Like, I mean, if anybody on here is interested, even just talking, the fact that we started this conversation, it will lead to that deal, right? We won't have to do it in that time for like, hey, we got a deal. Now we're raising money. Now we got to create the relationship. I listened to another guy talks on a podcast, and he says, dig your well before you're thirsty. That's like his big thing. Dig your well before you're thirsty, right? We got to make the connections now. We got to start learning about each other, seeing what people's appetites are. And then when we get that deal, when we find that 50 unit that we actually have a 42 unit we're looking at right now that we might have to make a decision on pretty quick here in the next week, because these deals are just moving so fast. We don't want to be thirsty, right? I want to already have the network riding. I want to have, everybody like, hey, texting me, hey, how we looking? You got anything? That's really what we want. So that we don't have, because there's a lot of work that goes into these deals. Once you get a property under contract, I mean, the work is just, it's a ton. And so if we could take a lot of the raising money side off of our plate, we have a deal under contract, we just call people up, hey, we got one. Here's the deal. We'll have a pitch deck out in about a week or 2. If you're interested, let us know. That simple, right? Not having to get on a phone call with people and really walk them through what it's like to be in multifamily and everything. We'll definitely do that, but it's always good to get those conversations out of the way, which is why this is really great. But yeah, that's what we're up to, man. We're always looking at deals. We're always trying to raise money and make really, really good connections and find awesome partners to join us on the journey.
Right. Yeah. Well, that's awesome, man. I know we're going a little past the time here, so we can wrap things up, but I just see some people that are going to contact you through Private Money Club. Yeah. So just reach out to Chris right on Private Money Club, or send me an email. I can connect you with them there too, or via Slack. And then you do anything in Texas, Chris?
We're not doing anything in Texas. I got a couple of guys in my network that are. We're primarily focused on Tucson at the moment. And if that market gets a little dry or gets a little crazy, we'll start to kind of venture out. But yeah, primarily Tucson.
Yeah, no, I hear you. Yeah, I know some people in Texas too, Ray. If you want to email it over to me, or email me, maybe we can connect and I can see if I can connect you with some people that might.
I have. Did someone say that? I didn't see it.
Yeah, they're talking about Texas.
Yeah, I know. So my wholesaling business, my fix and flip business, one of the guys that's in my network that I talk to a ton, he does a lot of deals in Texas. I mean, these guys are killing it down there. So if you do have something, some potential there, especially if it's off market, they love that.
Right.
I can always take a look at it and send it over to them and see what their thoughts are.
Yep. That's what the community network's all about, man. It's helping each other out and putting deals together. So I love it. All right, cool. So Chris, so thanks for being here, man. Can't wait to see what you guys have coming up next and what deals, and we'll definitely bring you back on. Was that helpful for everybody? Everybody like learning about the syndications? So I know Biz is doing more and more of those, and I've talked to some other investors recently that have some stuff in the works. So we'll see where that goes. But hope everybody has a great week this week. Had a nice weekend. Watching basketball, Chris? You a basketball guy?
No, not really, man. Maybe at the gym I'll catch it a little bit, but I listen to a lot of, it's weird. I listen to a lot of sports radio, so I'll hear it, they'll talk about it, but I don't really watch it much. Too busy, man. Too busy.
Liability. That's actually one last good question. So what's the liability look like as a limited partner, as a passive investor?
Sure. So, I mean, just like any investment, right? There's risk, right? There's always some risk in the deal. And when you say liability, meaning like the risk in the deal, is that what they're saying?
I think they're talking about like lawsuits, like if somebody was to sue you guys or something like that.
Okay. Sure. So
asset protection side.
Yeah. So we have everything structured, obviously, through the syndication attorney. Everything's LLCs. We have 2 LLCs actually for the deal. So we always ask people when they invest with an LLC. It's just, you get way better tax advantages and just protection. And so we're very, very covered as much as we can, right? I mean, we have all the paperwork in place with LLC. You got to break through 2 different things, 2 different LLCs to get to us. We actually have our main management is structured in Wyoming, so it's got even more protection. Nice. And so if someone comes after us, we're going to work our tails off to either fend it off and and not have to do it or settle or whatever we have to do. But when it comes to the liability side of it, I mean, we have about as much protection as we can put in place on it. But ultimately, it just depends on what's someone to come after us for. What's the liability going to be? Like, what is it going to be? And when that comes up, we'll have to deal with it, right? But yeah, we're fully covered. I mean, insurance, we got heavy insurance on these deals. Obviously, an attorney on call all the time who does all of our syndicated stuff, and then the Wyoming LLC, another LLC. So really, if they want to get to us or any of the partners in the deal, they have to go through a lot.
Right. Gotcha. Love it. Just thought I'd hit that last one I saw on there, but no, you're absolutely right, and probably good advice to use your own LLC to invest as well, just as one extra layer. And because of all the tax advantages with this too, as opposed to the direct lending. Direct lending, we always say it's not as big of a deal, but because of the way these are set up with the tax and stuff, good to use an LLC. So. All right, perfect. Great way to end it. So Biz, thanks so much for being here, man. It's great to see you.
So I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Click that alert button, actually smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.